everyone. Thank you very much for joining us today. My name is Corey Daharsh. I'm with Advanta IRA, and this educational webinar is on underground real estate, oil and gas, mineral rights investing. Again, I'm Corey Daharsh with Advanta IRA. My guest speakers and experts today on our subject matter at hand are Hiza and Kasey Huss with Carolina Natural Resource Group. I've got both of their contact information here on the screen, so if you'd like to reach out, feel free to take that down so that you can reach out to them. That QR code also goes to some great information about Carolina NRG. Kasey, thank you so much for joining me. I know we've had a relationship for a number of years, so really happy to have you on again, and look forward to today's presentation.
Thanks, Corey. Good to be back.
So just for the audience, I do want to let you know that you are going to be muted for today's presentation, but we do encourage your participation. You can use the questions box on the GoToWebinar panel to ask any questions that you have. It's likely they may be answered on the next slide or throughout the presentation. But when we finish today's presentation, we'll have a full Q&A, and I'll go through all the questions and make sure we address everything that you guys as the audience has to ask. You can also request with an email to myself, Jim, or Kasey a copy of today's slide deck in a PDF format. And anyone that's registered for today's webinar will receive a link to the recording that will go up on our YouTube page at Advanta IRA on YouTube within about the next 24 hours or so. So you can always also watch this back at your own pace in the future. That's pretty much the basic housekeeping for the webinar itself. Let me give you a quick overview of our agenda for today. I'm going to cover some basic information about Advanta IRA, who we are and what we do, some basic information about self-directed retirement accounts, how to get them set up and what type of investments you can hold with them, and some basic rules and regulations. And then I'm going to turn over to Jim and Kasey, and they're going to cover their subject matter expertise, which again is discovering how mineral rights can boost your self-directed IRA. So without any further ado, again, Advanta IRA is the company I work for. We put on these types of educational webinars. We have been in the self-directed industry for over 21 years now. We've got a huge roster of clients that hold just over $3.5 billion in assets under administration through our self-directed accounts. And every client of ours has a dedicated client account manager. So you have a white glove customer service representative, and you're not calling a call center and asking a new person whatever questions you have and explaining who you are and what you're trying to do. You really get a one-to-one relationship. It's actually kind of the nature of how Jim and I got to know each other. I used to be on the client account management team, and I was the appointed account manager for any clients Jim and Carolina Natural Resource Group would refer over. So when I transitioned to my current role in the business development team, it was a very smooth and simple transition. Basically, anytime this team makes a referral of a client to us, I already know a lot about the investment strategy and how to process it. And then obviously my job is to help that person with any questions they have, and then executing the application process to get their account set up. At that point, an account manager that is now familiar with Jim and his team facilitate the investment transaction. We make it as smooth and simple for you as the client as possible. A brief disclaimer before I get too much further into any educational content. This is strictly an educational webinar. Myself and Advanta IRA as a company are not allowed to convey any tax advice, legal advice, or financial advice. So everything you see here is all for educational purposes. Please be sure to consult your own CPAs, attorneys, advisors, whoever may be on your team before conducting any self-directed investment transactions. So what is a self-directed IRA? Simply put, it's an IRA account just like you're probably already familiar with a non-fiduciary custodian or administrator, so not a financial advisor, that allows you within that account to make any investment you'd like to, typically investments outside of stocks, bonds, and mutual funds, which are what those fiduciary or financial advisor companies stick to. So if you have an account with a Fidelity, an Edward Jones, a Merrill Lynch, a T. Rowe Price, and you say, hey, I want to invest into oil and gas, it's likely that they're going to tell you, no, you can't do that, because they haven't done underwriting and due diligence on the specific investment you want to make. That applies through a number of different asset classes. Again, we're here to talk specifically about mineral rights investing, but a self-directed administrator is one that truly allows you to invest into pretty much anything under the sun you would want to with your retirement dollars, and are experts as we are in the self-directed rules and regulations. So you say, hey, I want to invest into XYZ. We say, here's the proper structure or strategy to accomplish that and facilitate that transaction, holding your hand as much as you need to throughout the process. A lot of people have not heard about self-directed retirement accounts, and that's very common. These accounts have been around for a long, long time, but most people are with a fiduciary or a financial advisor who have a vested interest in not letting you know that these types of products and accounts exist, or making you think it's too risky or too volatile or too scary to take your funds out of their hands, where they're charging you either a percentage of the investments they make on your behalf or a flat rate fee that may be, pretty significant, instead of moving over to assets that you control and you have expertise in investing into. Only about 4% of only about 4% of US-based retirement accounts are self-directed. And the overall industry that we're talking about has close to $40 trillion in it. So it's an emerging space and market. And the way it emerges is through people listening to educational content like this, connecting with our staff and our team, or being referred by friends and family members. So kudos to you for being here and taking the initiative to learn a little bit more. But also, if you have a friend, a family member, a business colleague that you think would benefit from learning more about self-direction, please feel free to point them in our direction. So why do people switch over to self-directed accounts? The common reasons we see are that people are already doing some sort of unique investment strategy. So maybe you're already a mineral rights investor, but did not know until now that you could do that with your old employer 401k plan or your IRA account or whatever type of qualified funds you have. You just didn't know until this point that you could also bolster that investment strategy you're already taking advantage of with these dollars. So a new source of capital, if you will. A lot of people are getting fatigued with the stock market. Over the past few years specifically, it's been a pretty wild roller coaster ride. So even if people don't switch all of their accounts over to a self-directed account, when they learn that they exist, they tend to at least diversify a portion of their retirement funds into some sort of self-directed strategy. And then finally, the tax benefit of making investments with your retirement account are really, really great. These investments grow in either a tax-deferred or a tax-free capacity. So you're not paying taxes when your investment yields returns. That money is going right back into your retirement account. If you have a tax-deferred or traditional account, you ultimately do pay taxes on that money later in life when you take that money out of the retirement account. But in theory, at that point, you're retired. So this is just getting added to your ordinary earned income. And if it's the only income you're generating and paying taxes on, you're likely in the lowest tax bracket possible anyway. So that's one factor. The other factor is you could be investing with a Roth account, which is post-tax money, which means you've already paid taxes to put that money in that Roth account. You never have to pay taxes on any of the earnings or anything that that investment generates at all in the future. So those are the key reasons we see people switch over to self-directed accounts. A few rules and regulations about these accounts. You can, like I said earlier, pretty much invest into anything under the sun that you would like to. The only asset classes you're not allowed to invest into are hard to value collectibles or subjectively valued assets like antiques, fine wine, artwork, anything the IRS would deem to be subjective in value, and life insurance policies. There are certain rules. You could invest into a life insurance policy with a 401k plan. We don't see that too often, but if you have specific interest in that, reach out. I can point you in the right direction of some content. But that's it. Outside of that, as the slide earlier displayed, mineral rights investing, precious metals is a possibility, cryptocurrency, real estate, whether it's short-term, long-term, fix and flip, anything that you know how to make money by doing, there's likely a strategy and a structure for you to do that with your tax-sheltered retirement dollars. And then the only other way that the IRS really restricts your retirement investment strategies is by labeling certain individuals close to you as disqualified persons. You're not allowed to transact with disqualified persons, meaning sit on the other side of a deal from them, but you can partner with disqualified persons. So be on the same side of a deal as a disqualified person. My next slide, I'll illustrate exactly what and who the disqualified persons are. But before I do so, I do want to reference real quickly the taxes that do apply in very nuanced scenarios for self-directed investing. That would be UBIT tax, unrelated business income tax, and also UDFI tax, unrelated debt finance income. Those only apply in very limited case scenarios, and they're basically, if you're making an investment through your retirement account, the IRS basically wants it to be a passive investment, a passive income generating investment. So if the investment you make generates some sort of active income, maybe you invest into a small business that does have active income generated, UBIT may apply. It's not going to be a deal breaker in many scenarios, but it's something to understand and make sure you have your underwriting done for before you actually fund that investment transaction. And then UDFI is basically if you make an investment into an asset that's leveraged, so there's financing involved in the purchase of that asset, UDFI tax may be applicable there as well. Those typically don't apply in the investment scenarios we're talking about today, but I'd be remiss if I didn't reference them in the general capacity of self-directed rules for investing. Now, the disqualified persons, it's very simple to delineate. It's basically yourself, your spouse, your parents, your children, and anyone on the main trunk of your family tree, also extending to businesses that those individuals own or control day-to-day operations of. So you're not allowed to make an investment where one of those individuals or businesses owned by those individuals are on the other side of the deal, buying an asset from one of them, selling an asset to one of them. You can partner with any of those disqualified persons, but making a transaction with them is prohibited. Important to note that there are non-disqualified persons that are still in your close family tree. Your siblings are not disqualified. Aunts, uncles, other distant relatives, in-laws, other family members or friends are not disqualified if they're not on the main trunk of your family tree. So there are a number of different types of accounts that can be self-directed. A lot of people are familiar with traditional and Roth IRAs because basically anyone in the US can have them and contribute into them as long as you have earned income. But if you're a small business owner or self-employed, then you could qualify for a solo 401k, a SEP, or a simple IRA, which have higher annual contribution limits and do also offer a mix of traditional or tax-deferred and Roth or post-tax contributions in elective deferrals. And then we also offer health savings accounts and education savings accounts if you're someone with a high deductible health policy or have a young one in your life you'd like to set aside some investable money for qualified educational expenses. Feel free to reach out to me directly if you have any questions about what account type fits your needs best. I pretty much handle those conversations all day, every day, and can likely answer your question very quickly and simply. I want to reiterate real quickly, it's very important to invest with people you know. Always attend your various networking groups, get advice and feedback from people so that you're doing thorough due diligence and comfortable with the people that you invest with, either alongside or give your retirement dollars over to before you make a self-directed investment. Because again, you don't have a fiduciary or a financial advisor overseeing and doing due diligence on your behalf. The self-directed capacity is really what's important here. You are taking control in your own hands to make an investment, and you are completely in control of the possibility of outcomes for that investment. It's real quick and easy to get a self-directed account opened. The application process takes about 15 minutes to complete. The account setup and funding take about a week to a week and a half. And from that point, you're able to invest into any asset you may want to. So overall, if you found a deal that you wanted to invest into and set up an account today, you can look about 7 to 10 days out and be ready to fund that investment transaction. Without any further ado, I'm going to go ahead and turn over to Jim and Kasey for their portion of the presentation. Again, the topic for today is underground real estate, oil and gas mineral rights investing.
Thanks, Corey. I'll just start with a quick bio. This is Jim. You know, I was in the financial advice world. So out of college, I was a CPA, but I hated it. So I went into financial planning. And luckily for me, during 08, the crash of 08, I was following the hedge fund managers highlighted in The Big Short. So we didn't get killed, but also realized we were the patsy and had to find something else. And that's when I found oil and gas royalties. long story short, I sold my practice and I partnered with some guys in Texas, and I've been in it since 2010 in different formats. Started buying these things for hedge funds in New York and major university endowments, et cetera. We started CNRG going on 3 years ago now, and just to help Main Street put the odds back in favor of Main Street. We are super passionate about bringing this historically hoarded asset to Main Street. Most of the people that are buying this are either family offices or private equity backed. Multiple generations have been in it's just passed down from one generation to the next. And the couple of people that do, there are a handful of people that will help private individual investors, but they do it in a fund. And inside of a fund, as I learned when I first found this stuff, all kinds of shenanigans can go on, extra fees, all kinds of stuff. So we are passionate about providing deeded title real estate, not a fund. And these assets, as you will see, will offer decades of passive income with returns often in the mid to high teens. And as I said, it is multi-generational cash flow. We know multiple people that are third, fourth, fifth generation of oil and gas that have been earning monthly income from their grandparents, great-grandparents, great-great-grandparents generation. So as we alluded to, underground real estate's the title because mineral rights are real estate. This is the only country where private citizens can own the underground real estate. Every other country, the government owns the mineral rights. And there's some differences. There's some the unique. I mean, the commonality is that it is deeded title real estate. There's deeds filed with the county clerks, but it's different to the real estate above the ground. There's not a lot of ongoing maintenance, no repairs, none of that. The oil and gas operator above the ground who drills the wells and maintains all of the equipment. As the underground real estate owner, all you do is collect a royalty. There's very little competition, in the, whether it's the apartment space or storage space or now flex space, or even, just single home rental properties. It's highly competitive. The income type on those above ground types of assets are either active or passive, depending on the structure of the deal. With mineral rights and royalties, it is truly passive. In fact, it's called mailbox money. Before there was ACH, people would just go to their mailbox and collect a check every month. And there's no correlation to Wall Street, and there's no correlation to above ground real estate. So it's a unique asset. It's different from many other type of real estate you may have seen.
Yeah,
and with that, I'll turn it over to Kasey. Sorry.
Yeah, that's okay. I'm Kasey, and I'm a partner at CNRG. And as you guys can imagine, Jim and I love the new Paramount show, Landman. And if you watched it, you know that before any deals are made, before wells are drilled, it all starts with the mineral rights. So the first scene in the very first episode of this whole show starts with Tommy Norris, our landman, tied to a chair surrounded by angry cartel members. But if you'll remember, this hostage scene quickly turns into a math class on mineral rights. Tommy explains how his company legally owns the mineral rights beneath the ground, even if the land above it is cartel territory. He talks about leases and subsurface ownership, which we're all going to talk about today, and how the real power in Texas doesn't come from guns, it comes from contracts and the ownership of mineral rights. So how does all of this work? We're going to start just by talking about real estate. So take a look at this beautiful cabin. It's the perfect weekend getaway for family and friends. But when the owners bought this property, they only purchased what you can see on the surface. What's fascinating is there's so much more beneath the ground that meets the eye. You see, the owners of this cabin didn't purchase the rights to the acreage below the ground, the underground real estate. These are called mineral rights. And in other countries, the government owns the mineral rights, just like Jim said. But in the US, individuals can privately own the real estate below the surface, which goes straight to the Earth's core. Mineral rights are often passed down through families for many generations. And if you own mineral rights in the United States, you're part of a very fortunate and small group of individuals, an estimated 12 to 15 million people. Mineral rights are such a big deal because when you're a mineral rights owner and your minerals contain resources like oil and natural gas, you have the opportunity to make decades of passive monthly income and build real generational wealth. So, how valuable are mineral rights? When an oil and gas operator like Chevron or Exxon drill for oil and natural gas, they lease the mineral rights from the mineral right owners in exchange for an upfront payment and an ongoing royalty on the production of the wells. So if you own the mineral rights in this picture and Chevron drills an oil well, you will receive a monthly royalty check from that operator, from Chevron, for a percentage of the revenue from that well, as long as it's producing, which is often for decades. At Carolina Natural Resource Group, we buy mineral rights within the country's most prolific oil and natural gas plays. And we help other people invest right alongside of us. And as we'll talk about in a little while, we invest where there's already producing oil and gas. So we're not out in a pasture somewhere where there's, unproven oil and gas. So, yeah, as I said, the first way to, I'm trying to advance my slide here. The easiest way to benefit from an oil and gas investment within just a few short months is to purchase mineral rights where there's already producing wells on the acreage. This is a low risk investment because we can review the revenue that's produced by the wells on the acreage by analyzing months of check stubs. And then we verify the life and productivity of the well by using highly specialized software. And with those resources, we can confidently estimate our rate of return on these investments, which can often be in the mid to high teens. And these investments can provide decades of passive income. And if an operator decides to drill new wells on your acreage, you'll also receive income from those wells too, without you having to put up any money. And it significantly increases your rate of return. So I am going to let Jim wade us into some deeper waters and unpack the real value of this kind of investment and talk to you about some real acquisitions that we have purchased and helped other people invest with us over the last several months.
Yeah, thanks, Kasey. So this all sounds great, but what's it look like in the real world? So it's super important to know how we operate. We buy an asset with our money, and then we will offer up to 90% of it to private investors. And when we do this, you're seeing the front page of a two-page cover or two-page little document that we send out that has just the highlights of the asset. And in the bottom right, there'll be a link, or sometimes it's on the back, there'll be a link to a Google Drive. And in that Google Drive, we have all of our homework. We have the seller's check stubs, we have maps, we have any other due diligence documents for your review. So this asset we bought in the spring. We valued it at $1 million. The minimum was $100,000. It had 95 producing wells. Many of those, I think there was 20 in New Mexico, the rest were in Ohio, and it had 4 wells that were drilled but not completed yet. So there's 2 stages. Once a well's drilled, they have to complete it and turn it on. So it was Ohio and New Mexico. It was about the revenue was about 60% oil, 40% natural gas. Excuse me. There were 3 operators, 2 in Ohio and 1 in New Mexico. And, Kasey mentioned this is below the ground real estate and walk you through what that means. But so the potential for upside when they drill new wells, which she also mentioned, there's multiple ways we can earn money as the mineral rights owner. They can drill wells at the same depth in between the existing wells, so that they drill a new one in between 2, we get paid. But in most of the areas around the country, there are multiple oil and gas zones at various depths. we'll see here in a minute one we acquired where there's 10 depths that have not been developed at all. So that's super important. And the starting yield was estimated at 17% annualized. It's a very simple rate of return. We took an average of the seller's last 3 months of royalty income, divided it by the $1 million, or multiplied it by 12, divided by the $1 million. So just a few highlights of what this looks like in some detail. It was 7 counties, 6 in Ohio, 1 in New Mexico. As we said, 3 operators, 95 wells. The initial yield was 17%. It's currently at 22, and there's 2 reasons for that. One, on the seller's checks, the previous months, the natural gas price was a little over $2. But when we acquired this asset, natural gas was already up to $3.30. It's at $3.10-ish today. So we got a little bit of a bump in revenue right out of the gate. And then additionally, 2 of those 4 drilled but uncompleted wells have now come online and are producing royalties for us. You've got 2 maps here. There's a lot of colors. Sorry, hang on. You got 2 maps here. One on the left is Ohio, Pennsylvania, West Virginia, which is the Marcellus Utica play or Appalachia. The one on the right is West Texas and New Mexico, the Permian. The key thing to note here is the legend. Those are all of the different depths where there is oil and gas and wells have been drilled in these areas. So that's just important to note. Okay, Kasey. As we mentioned, we got a little bit of a pop. One of the checks was from January, and the price on natural gas on that check was $2.09. And as I mentioned, when we acquired it, natural gas had already risen to like $3.40. So we knew we were going to get a big jump in revenue right out of the gate. And the next asset we followed that one with was a little smaller. It was only in West Texas, valued at $550,000, minimum of $50,000. It had 20 producing wells in Martin County, Texas, 70% oil under Diamondback Energy. And the starting yield here was 16%. It's super interesting on these maps. It can get a little confusing, but it's the thing you need to pay attention to is the legend. Kasey, if you could forward the slide, please. Okay, so this is our acreage circled in yellow. These lines are called sticks in the industry. These are all horizontal wells in and around about a 5-mile radius of our acreage. And then we have the legend highlighted as well. You can see there are 15 different depths that wells have been drilled. And our wells are 3 to 4 years old, which is important. When wells are first drilled, the production is so high, you get a major drop in production over the first 2 years, and then it levels off, and they'll pay for typically 20 to 30 years. Okay, but when we zoom in on our acreage, notice the legend now is down to 5 different depths. So there's 15 depths drilled literally right around our acreage, but only 5 on our acreage. That provides significant upside down the road when the operator decides to drill those depths. As Kasey mentioned, we don't put up any money, but we get paid our royalty. So something else that we do that makes us a little unique is sometimes we'll put on the Wall Street hat and do some analytics. 2 years ago, we started buying natural gas, and when it was $5-6, it tanked to $1.50 last year. We decided to go do some homework and say, okay, did we miss something? What's going on? And what happened was everybody knows the liquefied natural gas exports are going to double by 2030. This is a known fact. These projects are under construction. Well, 2 years ago, 3 new projects were scheduled to come online, and the operators drilled a whole bunch of natural gas. Well, 2 of the projects got delayed, and 1 had a fire. So the demand did not come online. It is now coming online this year, but supply got ahead because they drilled early, hence prices collapsed. You know, we went through 1,500 pages of research from utility companies, Wall Street analysts, data center companies, tech companies, producers, everybody and anybody that's around the natural gas space. We also attended 4 conferences, and everybody's saying the same thing. Demand for natural gas by 2030 is going up about 40%. That's both from liquefied natural gas export facilities under construction, AI data centers under construction, and new natural gas power plants under construction. There was only one person that talked about the supply decrease, and that was a petroleum engineer in Pittsburgh. So every well declines, and as I mentioned, these newer wells will decline quite a lot the first 2 years. And so when you apply that, assuming they don't drill another well for natural gas, they just stop completely, by 2030, there will be a 30% supply decrease. We produce about 100 billion cubic feet a day. That's going to take us down to 70, and we need to get to 140. So in essence, we got to make up that 30% supply decrease and add an additional 40% demand increase. As we heard from multiple speakers and presenters at these conferences, and it's a quote in red, a tsunami of demand is heading directly toward us. So what are the benefits of oil and gas royalties and mineral rights? First of all, it's underground real estate with very high returns, mid to high teens to start. It's cash flowing from day one. There's a process. You won't get your first check for a few months, but you do get it from your effective date of the deed, which is typically the month you acquire an asset or the very next month. So right out of the gate, it's cash flowing. Flexible investment options, as Corey mentioned, self-directed IRAs, excuse me, 401ks, trusts, LLCs, partnerships, it doesn't matter. It is truly passive income. There is no management required, and it is completely independent to Wall Street and traditional real estate market cycles. Excuse me. Frequently asked questions. Is this too good to be true, and why isn't everybody doing this? There's a couple of reasons why everybody's not doing this. These assets are hoarded. They are hoarded by families. They are hoarded by university endowments. They are hoarded by some life insurance companies, and they are hoarded by private equity. Oftentimes the largest mineral owner in an area is the oil and gas company itself, Exxon, Chevron, etc. It is not too good to be true. You're just not shown this. You know, just like there's a lot of realtors, whether it's commercial or residential, that are shopping assets to you. There are not landmen showing you these assets, so you haven't seen them. You know, when I found this stuff in 2008, I'd never heard of it, but it's existed. In fact, mineral rights were written into the Texas state constitution in 1916. So anyways, that's why not everybody's doing this. And nobody sells, hardly anybody sells. You know, the only time people that we see sell it's a family or a fund selling 1/50th of what they own to go do something else, or they bought before any wells were drilled. Now the wells are drilled and cash flowing, and they want to sell and go do that again. Or it's we're talking to a seller right now. Their mom died, and so it's an estate that they want to sell. What's in it for CNRG? The way we make money is if we offer $1 million asset to investors, we bought it for less than that, and so we are making a profit. That's our profit, but we do keep our money in that asset, so our monthly checks rate of return is the same as yours. And our competitive advantage is a couple of things. We provide deed to title real estate. We keep our own money in it, as we've mentioned. There's no fund, but we also do an added research. We don't just buy any asset or that comes across our desk. We don't broker these assets, you know, where we're flipping the whole thing and washing our hands from it. We want to own it, and we want to be strategic about it. So like I mentioned with natural gas, we love natural gas. but also with oil. You know, the oil isn't going anywhere. Demand is not going anywhere, but up slower than natural gas. But at the same time, we want to be diversified. So, one of the advantages of us putting our own money in it is it's got to be good enough for our money. If it's not good enough for ours, it's not good enough for yours. Kasey, would you add anything to that?
No, I think you said it super well. I think that's one of the main distinctions is that, like you said, we're building our portfolio and bringing people alongside of us. So if we don't believe in the asset, we're not offering it to other people. So we're really passionate about the acquisitions that we've acquired. And, Jim is actually finishing up right now his due diligence on our next acquisition. And we hope to have that ready to show some folks by the end of next week or the next 2 weeks. The way that we share these offerings with people is folks reach out to us, say, yeah, we want to know when your next one comes around. And then we send out that summary document that Jim reviewed earlier, along with files where you can see our homework. You can review the check stubs, see the deeds and things like that. And we can walk you through that since you might not know what you're looking at. But we send that out to everyone who's interested, and it's a first come, first serve. So we've got folks that'll email us back, hey, we're in for this one, and then we go to PSA. So Jim's finalizing the due diligence on our next acquisition. If you are interested, think this is something that you might want to pursue further, please jump on Jim's calendar. You can scan that QR code. It takes you to his Calendly, and you can set up a call directly through there, or just shoot us an email or give us a call. And, it's pretty cool. Like with Jim and I, you can reach him directly anytime, interested in an investment or after you've invested. We're very accessible, and we're really passionate about making this process smooth and great for anybody who wants to come alongside.
Yeah, thanks, Kasey.
Yeah.
Corey, with that, we'll open it up for Q&A.
Awesome. Well, thank you both so much for the presentation today. Obviously, we've had Jim on in previous presentations. I think this is the first time that I've had the pleasure of having Kasey join and add her insight. So thank you so much for making everything extremely digestible for the audience. First off, a lot of these topics are, likely the first time that the audience is hearing about them. And, obviously I was following along with a little bit of knowledge myself, but everything, the way you guys explained it, came through very clear and easy to understand. So really appreciate you guys for that. Quick note for the audience, please add your questions in the questions box. I've got a list of them here. I'm going to start reading off. But if you have something that you want Jim and Kasey to address, please add it now. We've got some time to go through those. Without further ado, the first one here, it's several parts. I think you've already addressed a few parts, but I'm just going to read it in its entirety. Would we be buying the mineral rights on a piece of land that is part of a larger lot with other investors, sharing the income from the larger lot? Is this for accredited investors only? Is there a minimum investment? How long after investing until we start receiving income? Any expenses, property taxes, etc., and location? I know several factors there you guys did address, but again, just for continuity's sake, I wanted to read out the whole thing.
Yep. So I'll explain it, and this should answer all those questions. When we buy acres in a certain section, say in Texas, a section is going to be 1 square mile. And let's say we buy 15 net royalty acres or net mineral acres in 1 square mile, which is 640 acres. What happens when these oil and gas companies drill a well? If the well is 2 miles, it covers 2 square miles in 2 sections, and they just do the pro rata math. It doesn't matter what corner of what one of those 2 sections we are. The wells could literally be on the opposite side than where our specific tract is. But by law, in every state, those acres are where the wells are going are all pooled and combined together. So if we bought 15 net royalty acres and there was 1,500 acres, we have 1%. So we would be getting 1% of those wells. Again, we could be on the eastern side of the acreage and the well be on the western side. It doesn't have to be directly over us or through our acreage. So that's how that's allocated. And when you buy this as a deeded title, you're buying a percentage of acreage from somebody. It'll be from us, but down through the chain, going backwards on the title chain. In terms of how long it takes to get a check, so the process is, as Kasey mentioned, we put out an offer or an acquisition, and you say you're interested. A week or so later, we'll have a purchase and sale agreement, PSA drafted. You wire us money, we get you a notarized deed within 48 hours. We take those deeds and we get them recorded at the county courthouse. That can take anywhere from a week to 6 weeks if you're in Ohio. And once we get all of those back, then we have to notify the oil and gas company about all of the ownership changes. They will quote us 90 days to process the transfer of ownership accounting. Now, in the meantime, nobody's going to get paid. We're not going to get paid. The seller's not going to get paid. That royalty income is going to be built up in what's called suspense. It works like an escrow account at a law firm. By law, the oil and gas company is not allowed to touch it. So it just sits there until they're done. On your deed, you have an effective date. For example, if the effective date was August 1st, you are owed royalties on all oil and gas produced from those wells from August 1st forward. August oil production will show up on the September royalty check. August natural gas production will generally show up on the October check. And the reason is oftentimes it's not just natural gas. There's other gases, propane, butane, et cetera, that have to be separated out, which takes longer. And so what ends up happening is your first royalty check might not be until 4 months, but you will have it retroactive all the way back to your effective date. And then it will be monthly thereafter. I think there was one other question, Corey, but I think I covered most of them.
Yeah. The other question was any expenses like property tax, etc.
Yep. On the royalty checks, there are, most of the time there are expenses. There's expenses for transportation. There's expenses for processing for natural gas. And there are some ad valorem taxes or severance taxes. We buy, whenever we acquire anything, it's the net check. So not the gross, the net of all those taxes. So when we say the net, the return is 17%, it's based on the net. The operator handles all those. You don't have to handle them. So it just comes right off the check. And then the minimum is generally $100,000. You do not have to be accredited. This is not a security. This is deeded title real property.
All right. And the next question here, is there any UBIT involved in these strategies?
Nope, zero. It's all passive.
All right. Next one, if an operating lease expires and needs to be renegotiated, who does that?
The only way a lease would expire is if there are no producing wells and they don't drill a well within the lease term, which is typically 3 years. When you acquire existing wells, the leases do not expire until no wells have produced plus 10 years. There's a clause called held by production, HBP in the industry. So as you looked at those maps, they've got 10, it's oftentimes 5, 10, 15 different zones to drill. And the only way the lease would expire is after they drilled all of those, put as many wells as they possibly can, and then all of those wells have produced for 20, 30, 40 years, and then you add 10 years. So all of us on this call today will not be alive.
So that, just from my own side, raises an additional question I'd like to ask Jim. What is that plus 10 years for? Is it something in the industry where a well might stop producing, but there could be like a 5-7 year threshold where it starts producing again? Could you expand on that?
It's a couple of things. It's state law, but it's really a couple of things. It just gives the operator, maybe they've drilled zone A at 5,000 feet and there is oil and gas at 7,000 and 9,000 and 10,000, but maybe it's not economical yet, or the technology isn't there yet. We just put under contract for our next asset, a piece in West Texas, excuse me, just north of that acreage. The operators started drilling a different depth called the Dean Formation. And they tried that Dean Formation 10 years ago and they could not make it work. It had nothing to do with the price. It's just the technology wasn't there. Well, it's there now, and these wells are coming on as monsters. So it just gives the operators time to get the technology right to fully develop the reservoir.
Got it.
Jim, I'll ask, I think the spirit of that question is really assessing the risk. So you've done this for over 16 years. Have you ever encountered this, an investment where the lease expired and then you have issues? Have you dealt with that?
No. Now, if you have one, now we own mineral rights with no producing wells, and we signed a lease, we negotiated a lease with the operator, and it's a 3-year term. We are a year and a half into it, and they haven't drilled yet. If they don't drill, what ends up happening is sometimes the lease will have a clause where they can extend it for a year, but oftentimes it just expires. It will get released. And so we would get another bonus, because every time it gets leased, when you're a mineral rights owner, you get a bonus, and then it'll start a new 3-year clock.
I gotcha. But when we are investing where there's producing wells, it's not. It is not. It's very low. Doesn't apply. Gotcha.
All right. So the next question here, are you only buying wells that are already drilled? I guess that more so means property or land that's already drilled. Do you know of any tax advantages? Is there a downside in buying one that includes the drill welling where I believe there is a tax deduction available?
All right, so there's two different sides of the equation, and the barrier that between the two sides is the surface of the land. The drilling occurs above the surface. That's where you poke the hole in the ground. That's where the pump jacks are. That's where you get the tax deductions. The mineral rights are below the ground. You don't get those tax deductions because you are not participating in the actual drilling of the well. You just own the land that they are drilling on. It would be similar to you own a piece of raw land and Chick-fil-A builds a building on it. They're going to lease that land from you and build the building, but you don't get the depreciation on that building because you don't own it at all. You just own the land it sits on. That's kind of how it works. So there is a tax deduction, but in an IRA, it doesn't matter. On the 1099 income, you only pay federal taxes on 85% of it on the royalty income. That's the only tax break.
Got it. I guess in theory as well, in that scenario you outlined, you're not getting a cut of the profits that Chick-fil-A makes from selling their chicken sandwiches either. So
that's
similarly
right.
Put. Yeah.
That's right.
Okay. Next question here. And I believe you may have already addressed it, so maybe just a quick synopsis. Can you give a general picture of how the investment process works from initial funding to then seeing a return? I think that was actually addressed in the first question I outlined. So
yeah, it takes about 4 months from when you've wired your money to get your first check. Now you'll have your hard copy of your deed. When we get those back from the county clerks, you get the original copy. I send I make a copy of it, but you get the original version as a hard copy. We send a soft copy to the oil and gas company to get them started transferring the ownership.
And funny enough, I just scrolled down and that person posted, "Thanks, got it." So my apologies.
Yeah. Yep.
What are the risks of investing in these mineral royalties? I know you've also covered that in the presentation and in a previous answer, but again, if you just want to quickly bullet point the risks associated.
Yeah, so let me start by, this is a frequently asked question. What happens when the wells run dry? Well, they don't technically run dry. We have, based on the U.S. Geological Survey, we have an idea, a really good idea of how much oil and gas is down there. Currently, under current technology, you drill a well today using the best technology, you might get 40% of what's down there out. That's the best we can do. we do have technology to go back into that well bore 20, 30 years down the road and repressurize it and maybe get another 10%. So they don't technically run dry, which is why this is a great asset. But more importantly, shoot, now I forgot the question, Corey.
Oh, the risks. What are the risks?
Yep. So the material risk is when you look at a royalty check, and we showed you just a sample of one when we showed you the nat gas price at $2.09. It is nothing more than how much oil and gas came out of that well times the commodity price times your ownership. That's a royalty check. When these wells are producing, we know they're going to decline a lot in the first, call it 18 months to 2 years, but after that, it is a long, slow decline over decades. So that's not a material risk, but what is a material risk is the commodity price. What's going to move that check is if oil, the production of that well went up or down. It doesn't move a whole lot from month to month unless they, shut in the well to do maintenance on it, which will happen when they're older. Otherwise, it really doesn't move much. It's the commodity price. Natural gas went from $5 to $1.50 back to $4 and it's at $3. That's going to bounce around all over the place. Your risk is the commodity price. You buy into an asset, say you're doing 16%. If it's all oil at $65, oil goes to 32.5, you're now making 8%. We bought one, I guess it was 2023. It was a mixture of oil and gas. Well, last year, as I've mentioned many times, the gas piece went down. When we bought it, it was a 15% yield. We still made 11% last year.
Yeah, and as
one other. Go ahead, Kasey.
I was going to say, as you've mentioned, Jim, as one of the reasons we mentioned the natural gas outlook is that we are seeing nat gas prices going up. So we have really been heavy in investing in nat gas. We like oil too, because we like to diversify, but because we know our royalty checks are going to be affected by that commodity price, we are very positive about the commodity price of natural gas because it is going to grow and grow. So we're really like those nat gas investments. And one other thing I wanted to add to it is when we have an acquisition, we are always buying acreage where there's upside. So we like to know, okay, we're going to make, 16% out the gate, but what's the upside? Are there room for additional wells, additional depths, and so every acquisition we have, there's room for growth. So we're not just going to get it 16% and then wait for it to decline over decades. No, there is opportunity for that rate of return to increase, over the life of this investment.
Yeah, that's a great point, Kasey. I think I could give you a real world example because I don't think many people understand how much that upside could actually be. So a friend of ours, this was in 2017, acquired royalties in Pennsylvania. It was all natural gas, and there were 4 wells. The wells were a couple of years old. They were making about 18% a year. They put $400,000 in. They were making about $6,000 a month. There was one year, I think it was 2019, I can't remember, but there was one year where natural gas prices declined quite a bit, and they made like 6-7%. Well, back in 2022, they were back making that $6,000 a month. Through July, their August check was $110. So obviously they called us. And we said, call the operator, and they're probably doing maintenance on the wells, which is what was happening. The operator said, yeah, we're doing maintenance. They'll be back online shortly. Well, the next month in September, they called the operator, September, they got paperwork in the mail. They didn't know what it was, so they sent it to us. The operator had drilled 3 new wells. Their ownership was really small. We're talking 0.0000 something, small. In October, they called the operator and said, are we going to get a check? And the operator said, are you sitting down? Now remember, this was an original $400,000 investment. They had already made all of that money back in 5 years. And now their first check in October with these new wells was $51,000. They made all of their investment back again in 6 months. And now today, a couple of years later, after those new wells have been producing, they're now making 25% a year on their original investment. That's how powerful new wells being drilled can be. And Corey, back to your 10-year rule, you know, somebody that invests with us, her and her sister inherited a portfolio from their grandfather. It's a large portfolio in West Texas. We were having lunch with her in Houston a few months ago, and she pulled out a check, and she didn't know what it was. She said that acreage had stopped producing and paying them royalties like 7 years earlier. And she didn't know why she was getting a check. And when we looked at it, they had drilled 3 or 4 new wells on that property, and that check was several $100,000 for 1 month.
Yeah, and the reason why when they drill new wells, those checks are so enormous is because when they initially drill a well and poke that hole in the ground, the pressure is so high that the production is extremely high right out the gate. So you make a lot of money back right at the top of those wells being drilled. And then
I believe Casey's audio might have went out. Jim, are you still there?
Yeah.
Oh, sorry. Yeah, so can you hear me now?
Yeah, I can. It cut off when you said the word initially, so at the very beginning of your explanation.
Oh, I gotcha. Okay, so Jim, maybe I'm just going to throw it to you just to explain why do you mind unpacking why the checks are so large when the wells are drilled? Okay.
Yeah, so when they first drill a horizontal shale well, the pressure is so high, the volume is extremely high. And that as that pressure drops over 18 to 24 months, the volume is going to decline 60, 70, 80%. We know this. So you can model that in when you make an acquisition to make sure that, you know, after that drop, you're still getting a very healthy, nice rate of return, but you can make a lot of money, you know, while it's doing that in the first 2 years. But if you buy it afterwards, then, you know, you want a little bit higher rate of return. That plays in your favor. As Kasey mentioned, we never acquire something that has no room for upside. We want new wells drilled on our property. You know, again, back to the one I think I mentioned, we started out at 15%, and last year we made 11. Well, 2 weeks ago, we get paperwork in the mail from a law firm for an oil and gas company. They're going to drill 8 new wells on our property. So when they drill those wells, our revenue is going to go through the roof. I don't know what the rate of return will be. We'll have to wait and see, but it'll be a lot higher than 15 where we started.
All right, and so I know we're right at 1 o'clock. There's like 3 or 4 more questions, so we'll try to wrap it up close with time. Going back to the possibilities of downside. Someone just asked, what if there's a fire or explosion? Do you lose the investment? I think that kind of, correct me if I'm wrong, Jim, but that's more so kind of like, that's essentially in your explanation from earlier, that's Chick-fil-A's problem. That's not the landowner's problem, correct?
It is. And the fire I mentioned earlier was at a natural gas processing facility. It was not at the wellhead. It's rare.
But even if it is, that's the operators, we have no liability when there are issues.
Right, no liability, no environmental liability, no liability being the mineral rights owner. Now, production will be shut down while they fix it, so we won't get a royalty check, but that's it.
Got it. Okay, the next one here. What's driving the huge demand for LNG, and how much does it have to do with Europe?
Quite a bit with Europe. We are basically going to be Europe's largest supplier, displacing Russia. That is a massive portion of it. Also, just the development in all of Southeast Asia, the insatiable energy demands over there, that's the 2 major places where our exports are going to go.
And that piggybacks into another question I see here. What impact will industry experience when Russian production returns?
Russian production can return, but Are the European countries going to take it? Number one. Number two, the LNG export facilities have already factored all of that in. You're talking one of these facilities is going to cost 10 to 15 billion dollars. One of our investors used to be in the C-suite for an for a natural gas company that not only drilled wells but also was an LNG exporting company. We have no problem with these facilities and seeing that demand go away. It's not going away.
All right, and two final questions. This first one I'll actually answer the first half of. What happens if the investor dies and or wishes to sell? At least relative to a retirement account investment into a mineral rights asset, the investment itself and the account typically in its entirety gets transitioned into a beneficiary IRA where whoever that investor listed as their beneficiaries inherits the investment as is. In some cases, that beneficiary may choose to no longer hold that asset and wish to sell. And with that component, I'll let Jim take over.
Yeah, we actually had an investor die 2 years ago under you guys, Corey, and it went to his 3 kids. And so on our end, what we had to do is we prepared the deeds to go from his IRA to his kids' IRAs, got them filed at the county clerks, got them over to the operator to make that change. So that's what we did on our part. If anybody wants to sell, call us first. We're always looking, we have investors looking to buy, we're looking to buy. Oftentimes the operator will look to buy. We just got paperwork for our last acquisition where the operator's done transferring the ownership, and on the paperwork it says if you want to sell or consider selling to us, call us. So they're looking to buy. Additionally, there are 2 auction firms that are pretty big. They each do about $2 billion a year in oil and gas asset transactions. You can always sell through them. Oh, by the way, in 16 years, I've never had anybody sell.
And Jim, I remember that scenario and that beneficiary situation off the top of my head. It was a relatively simple process. We just collect new application paperwork for the beneficiaries, and on the back end, my team and Jim's team coordinates all the recharacterization and retitling needed. So it's a pretty sweet and simple process. Those family members are often dealing with their own grief and everything, so we try to make it as simple and smooth as possible for all parties involved there.
Yeah.
And the final question that I'm going to leave here with, I believe that this is another long one, and I believe some of the factors have already been addressed, but again, I'm going to read it in its entirety for transparency's sake. Does CNRG serve as an asset manager to review operators' operations on behalf of the investors? Is there a fee for asset management? How does CNRG make its money? Is there the ability to audit asset manager and or operator data periodically? How is an investment's value determined?
Okay, we don't manage anything. It's as deeded title real property. Once you acquire from us, the only thing we have our hands involved in is getting the deeds recorded and getting the ownership transfer done at the operator level. That's it. No ongoing management fees. And no, you cannot audit Exxon or any other operator. We make money. If we have $1 million asset, maybe we bought it for 800 grand. That's how we make money. That's it. No ongoing fees. And what was the last part of the question?
How is an investment's value determined?
Determined on several factors. What's the diversification level? What's the monthly cash flow? How old are the wells? What's the upside? What's the activity in the area? That's how we basically evaluate it.
All right. Well, really informative Q&A session here to wrap up the presentation. I implore anyone that is interested in learning more about the investment opportunities that Carolina Natural Resource Group have coming up soon to use that QR code, the phone number, the email address here, or check out their website. Please feel free to reach out to myself if you have any questions about utilizing retirement dollars in these types of investments. Jim, Kasey, thank you again so much for everything you brought to the table today. I'm sure that a lot of the audience members here will be reaching out soon to learn more. And any final words or parting messages for the attendees as we get signed off?
No, I'm
Kasey?
grateful for grateful for your time. And as I mentioned, if you're interested in seeing our next acquisition that we're going to be sending out in the next week or two, please email Jim and let us know, and we'll get you that information.
Yeah, thanks, Corey. We look forward to welcoming to some new investors to the world of oil and gas mineral rights.
Awesome. All right. Well, thank you all so much for participating today. Again, if you'd like a copy of today's presentation deck, you can email myself, Jim, or Kasey. Also, you will receive a recording link to YouTube in about 24 hours when this gets rendered and posted. So you can watch this all back at your own convenience. Feel free to check out any of our other educational webinars, advantaira.com/events. You can see what we've got coming up. And with that, I hope everyone has a great rest of your day. Thank you so much.
Thanks.